Welcome. The purpose of this webinar is to have a look back over the past financial year and bring you what we have seen from the revenue agency's activities across that year. We do so from the lens of the experience from over our 3,000 accounting firms across Australia, ranging from pretty much all the second-tier brands to international networks, including Australian networks, multiple office practices, multiple partner firms, all the way through to sole practitioners. And their collective of their hundreds of thousands of clients that participate in Audit Shield and the many more returns that are associated with those clients. Audit Shield is a very broad definition, has a very broad definition of audit that we cover. So we're talking about audits here from the Australian Tax Office, the various state revenue offices, and all the taxes they are chasing, and work-cover authorities and Fair Work, just to name a few. One early headline I'd like to share with you before we really get into the detail is that we've seen an increase of 22% in the level of audit activity that has been presented to us by way of claim as compared to last year. So that's an increase there. Okay, so let me introduce to you our panel for today. So most of you would have seen Rod Spicer in one of his many presentations across the years. Rod is ex-More Australia with around 25 years actual practice experience there, plus his 12 years with us at Accountancy Insurance. He heads up our Australian and New Zealand underwriting and claims area. He's never short of an opinion or a prediction. Welcome, Rod.
Thank you, Roman.
Okay, this year we introduced you Michael Sexton, so he's new to our webinars. Not only does Michael deal with the Australian and New Zealand claims, he also heads the claims for our Canadian operation. Michael also has 25 years experience in middle-sized practices in Australia and his 7 years with us at Accountancy Insurance. My name, for those who don't know, is Roman Kaczynski. I'm the Executive Director of Accountancy Insurance. And I'm responsible for 20 years of practice experience from small to medium-sized firms. So at Accountancy Insurance, we are not only the underwriting agency that has been the pen that holds the pen for the underwriter, but also we have the claims management authority, which means we use the accounting practice knowledge, experience, and expertise of the three of us, plus the rest of the 10 strong claims handling staff to process your tax audit claims. And in most cases, the claims are processed for payment in 2 days or less. We keep saying we are your best debtor. We've been doing this for 20 years, and we are the only provider that provides a stable, replicable, and durable process and offering, as evidenced by our 20 years of doing what we do. For accounting practices, what is relevant is that unlike the other options of just referring away to your client or a third party for them to own your client, with us, your client is not our client, you are our client. With Accountancy Insurance, you always stay in control of your tax audit insurance program. Okay, let's get started into what we've seen over the last year. So, Rod, this has been an interesting year to say the least.
Yes, Roman. Every year is interesting. I think as we come out of the risk of going back in time, the post-COVID era, that's what it was. We've certainly seen normality, if you like, return to the type of claims and frequency of audits that we're seeing. Frequency is increasing, and the mix and type of claims, which is what we're really going to work through now, has been interesting to see how they've moved from one year to another. Now, the graph or pie chart that we've put up here, as you'll see, has an asterisk next to it. So the largest claim category that we saw in terms of volume and number of claims was what we allow and have claims for ATO, individual excess super contributions tax assessments. Now, people may or may not know that we cover that. We've certainly, and I have certainly in my presentations to accountants, and our account managers have been making that point to accountants that use Audit Shield to just make them aware. And as a result of that, call it awareness program, it was more volume of claims that got lodged, caused it to be the #1 claim from a frequency point of view, but that is not reflective of the ATO having any more or less ECT matters. It was just really a catch-up factor in terms of volume of claims. So for that reason, we're going to leave that pie chart because it skews the actual reality of what has happened in the last financial year, and move to the next pie chart, which is really the technical or the actual position of what we saw from an audit frequency perspective in the last financial year. So what do we see is a quick snapshot, and we'll go through it a lot more. Obviously, the ATO is the largest government revenue authority in Australia. So it combined, even though we split them out, makes up the vast majority of the claims from a total percentage perspective, broken then down into a whole bunch of different categories, which we'll work through in some more detail for the more top line claims. We also cover state revenue initiated audit activities. So that's every state and the 2 territories in Australia. And by combining those payroll tax and land tax audits, if you like, which are certainly showing an increase, then combined, they were more than 20% of our claims in the last financial year. We also cover the workers' comp authorities in each state, as well as Roman quickly mentioned, Fair Work Ombudsman and some other government related authorities that are probably linked more to employer obligation compliance versus tax and collection of taxes in Australia. Interestingly, payroll tax combined across Australia was the largest category that we had last year. Work-related expenses from the ATO was the next, and the third that rounds out, if you like, the top 3 was employer obligation audits, which in the main involved superannuation guarantee.
So if we have a look back, just a reminder of what last year looked like, just to sort of do a contrast and compare there, right? So we sort of see the payroll tax was up there still last year, was there, and employer obligations was our number 2.
Yeah, correct. The big mover, if you like, was work-related expenses, which wasn't far off doubling in terms of volume from the year before, which, as we'll talk about in a minute, is reflective of what the ATO said they were going to do, and we'll come to that in a minute. And when I look at ATO, I combine there the work-related expenses and the rental properties to, again, get to around about 20% of our claims. Again, 2 key target areas that the ATO said they were going to look at. And from a frequency perspective, that's correct, as Roman said. Payroll tax, employer obligation, GST, and of course income tax making up the majority of our claims that we've seen really over the last 2 financial years.
Okay, so let's drill down into our top 3. Just have a bit of a dance around. So you've already named the top 3 so far. So we've got payroll tax. Obviously, we represent that as all states into one category. So income tax, work-related expenses was up there number 2 this year, and the employer obligations at Old Faithful always shows up in there. So let's drill down, Rod, and let's go into payroll tax in sort of a bit more detail.
Yeah, thanks, Roman. So interestingly, when we break it down on a state-by-state basis, we saw a reasonably substantial increase in volume of claims coming out of Victoria, WA, Queensland, and surprisingly, to be honest, New South Wales dropped down, but it's still a high proportion of New South Wales payroll tax audit activity. It was just year on year, the numbers went down. I have a bit of a theory. Us 3 are based in Victoria. For those that live in Victoria, you'll know we're basically broke here. So my view is that Timmy Pallas, the treasurer, rocks into the State Revenue Office every Monday morning. They have to buy him a coffee because he's got no money. He spent it all. And he says, how much are you collecting this week, you lot? Because we're broke and your job is to bring in as much payroll tax, stamp duty and land tax revenue as you can. I'll just make more things taxable and I'll do the media conference. You guys go out and get all the money. So I'm not surprised that we are just getting more and more and more payroll tax and even land tax audits in Victoria. Now, probably biased on that, but I actually reckon that's probably not that far off the truth. Other states, WA definitely, for a number of years now, has had quite a high proportion of payroll tax audit activity. And when I visit WA a few times a year, accountants keep telling me, yep, the Revenue Office over here is very active on auditing from a payroll tax perspective. Queensland, again, New South Wales, South Australia. We're still seeing a lot of areas that are being audited. And in the main, the things they're looking at are grouping. That is then just about their number one target area, because if they can get employers that are probably not registered for payroll tax, if they can group them and get them having to pay payroll tax, it's a big win for the state revenue officers. Contractors is another key area they're looking at. Employees in other states where they haven't registered in the other states, and employers that aren't registered at all, but information suggests that they're over the threshold and need to be registered. Where do they get that information? Well, it's pretty obvious. The ATO, the state revenue officers, the workers' comp, work cover authorities, and anyone else, they're all sharing the same data. So imagine if you've got wages of, I'll just make up a number, $2 million on the PAYG summary, and the work cover summary has the same, and they're not registered for payroll tax. It's going to be a pretty easy win for the state revenue office to start investigating them. So the data that's driving it is coming out of the sharing a lot of the time, and the other mining of data that state revenue officers are doing. So I can't see it going away, and it'll just get more and more, I think, over the next few years in the payroll tax sector.
Number two there, Roddy, is what they keep saying they're going to do, and they have actually delivered and done it, haven't they? With work-related expenses. That's right. So probably for the first year since we've been doing these stats, look, the ATO come out in about May each year, call it their top 5, their hit list for the upcoming tax season. And in the past, I've gone, yeah, no worries. You're more gearing this towards, I thought, just the self-preparers in the up to 31 October, and we hadn't really seen it flowing through. But this year we did, with work-related expenses, being in the top 3 categories probably for the first time in the years that we've been doing this. What are they looking at? Motor vehicle, travel claims, mobile phones, clothing, dry cleaning, laundry, overtime, union, you name it. If you've got high numbers in your work-related expenses, normally relates to large refunds, then we've seen a definite uptick in ATO audit activity. And I said it before, but I'm going to throw it in again. Throw in rental properties, which is another one of the key areas that the ATO said they were focusing on. And we're at more than 20% of our claims coming from those 2 areas combined. Okay, we've got a question. Let's see if we can have a look at that question. Panelists, no, I can't.
Yeah, they've raised their hands, so can they talk to us?
I'm not sure how to do that.
Click on the 3 buttons next to their name. I'll do that. Yeah, that one.
Okay, that's the gentleman who's with us, so I'm not sure. Okay, let's go back to the webinar. So it's work-related expenses. Also, let's not forget with work-related expenses, they're having a good look at the accounting practices themselves with
absolutely
with the profiling of those. So it's not only the specific aspects here of the types of claims they're doing, but they're also looking at the practices themselves, whether there's any sort of patterns of claiming. Do they have processes to validate the claims themselves? So they're definitely. We have seen some of these work-related expense focuses in practices come from the practice review themselves.
And I always, being an accountant, well, the 3 of us always find it interesting, given the client has signed off that everything's true and correct, and they have all the receipts and records in the declaration, that how the matter there ends up is somewhat slightly / majorly different to what they all signed off on as being true and correct, and they have every substantiation document that supports that. The biggest one's logbooks. I'm telling you, you know how many audits I see where it just falls apart through non-compliant logbooks that in many instances the accountant's never seen, etc. So the ATO love a logbook that isn't compliant, because they just win every single time. that the logbook's not compliant.
Very good. So that's work-related expenses. Let's go to the one that we always say, the old faithful employer obligations, which is always in our top list.
But I think with employer obligations, now in this category for us, we cover pay-as-you-go withholding, superannuation guarantee, and FBT. The biggest category in there is easily superannuation guarantee audit activity. Now, we said it was the old faithful, but the old faithful has changed in the last 4 or 5 years on the back of single touch payroll. So anyone that still thinks the ATO won't catch them out if they pay their super late is just living in dream world now. But unfortunately, I keep seeing far too many people living in dream world still, thinking they're going to get away with not paying it, they're going to get away with paying it late, etc., etc. And the ATO are literally just sitting back with all the data from single touch payroll and picking off employers for audits, or really what they're doing more and more of, which is not something that on face value we cover, is literally sending employers letters and their accountants saying, you paid your super late, where's your SGC statements? You should have lodged them by now. We'll give you a month to lodge them or we'll audit you. So they're taking this, fix up your outstanding compliance work first, or we'll audit you. So what I'm seeing and thinking is that everyone hasn't quite caught up to this way of thinking yet. And one of the main reasons is most accountants don't do the payroll for their clients, and they don't actually know that they've paid late or haven't paid until months and months and months later. So it's just a key area, I think, to be more and more mindful of, that the ATO knows more than you do, and be aware of that when you're dealing with your clients. But our claim stats are on audit activity in that space, not filling in and lodging outstanding SGC statements. It's audit activity where you're validating, justifying, having to support the super guarantee calculations, the FBT, and the PAYG, etc. So it's over 10% of our claims. So it's taking up a fair proportion. And the reason the ATO are obviously going so hard at it, and I keep saying, is, well, every dollar of superannuation guarantee contribution that some employer's not making now is a dollar the government's got to find in 20, 30, whatever years it is when that person's retired and they don't have enough money and they put their hand out for the age pension because the employer didn't pay their super contributions. Now, payday super, I think, just like why was single touch payroll introduced, well, payday super is the next round where they're trying to tighten the gap, which is probably billions of dollars now. Well, I think the last time I saw was 600 and something million dollars in estimated unpaid super. It's be well over $1 billion probably now. So the ATO go hard at it. They're not happy with it. And it's just going to continue to be a major audit focus. And accountants and their clients just need to be well aware of how this system now works versus how it used to work 5 years ago, because they're vastly different these days.
I'm sure we say this pretty much every year, because this claim or the audit type shows up every year as one of our top. That there's an opportunity for the accountants to go and educate their clients. And going back to the practice days, I know, like you go and you talk to your clients about it. It's one of those things that you can, they've still got to do it. So it goes back to that original premise that you put up right at the start. That doesn't matter how many times you get told. People still think they, as a business, you sort of can use this as sort of working capital for a period of time. And I think those days are getting less and less now, and being more and more numbered, if you like.
Yeah, well, when payday super comes in the next couple of years, if it gets off the ground, then that'll take away that working capital argument 100%, because it's pay now or face the consequences, which as an employee, I think is a good thing. As an employer, well, I have to pay it sometime. I've just got to pay it a bit earlier.
Yeah, no, that's good. So touching back on a point, I don't have a slide for this, but just going back to the point that Rob was making before about this blend, if you like, of types of claims that we see. And so I kind of look at it, I try to break down the claims into sort of 3 areas, and Rob was touching on them earlier. So if you sort of say what are income tax returns audits, so CGT audits, data matching, full general combined, foreign source income focus, pre-assessment, rental properties, work-related expenses, ADO high loss. So basically any audits that fit in those segments of our pies that are actually in regards to a tax return. And then the next segment sort of I've looked at is to say, okay, what are state-based audits? And so land tax, payroll tax, stamp duty, work cover, those aspects. And then there's a third category called other audit, other ATO audits. So excess super, BAS, SMSF audits, COVID-19 audits, which we still get such a small number now, it's not funny, but and employer obligation audits. So they're not necessarily income tax return audits, but they're audits by the tax office on other things. So basically, if we look at that mix, so the mix of what we see in there is the ATO income tax audits, as Rob was saying, nearly half. So 45 to 50% of all the audits we see fit into that broad brush. The state-based audits range from 20 to 25% of all the audits we see in all those categories. And then the other category is 30 to 35% that are covered off in there. Now, the thing to note from a trend out of all of that is that, and we've touched on this already, so this is just to make that point again, is that the state-based audits, the percentage is growing. So we're seeing more claims coming out of the state-based. That's a growing number of state-based audits that are developing. Okay, so we've got now I'll get back to here. So we've got a new perspective on that we want to introduce to you all this year is to have a look back over how long audits actually take to complete, from the date the audits are notified to the dates they are finalised. So although there's a correlation between the time audits take to complete and how expensive they are, what we're looking at here, this perspective, is more about how efficient the revenue agencies are in handling the matters from their perspective. So it includes when they start it and when they finish it. And so obviously, as we all know, there's gaps in between as far as waiting for them to review and come back and all that sort of stuff. So this is just looking at it from the revenue agency's perspectives of how long they're taking. So Michael, I want you to run us through this slide here, please, for us.
Thanks, Roman. Just before we do, we've just got one question from a participant from Michael Curtin. He says that given that most accountants are registered tax agents, which is a federal jurisdiction, to what extent are clients covered for work we may have done in assisting them comply with state jurisdictions, for example, payroll tax and work cover? Well, as Rod's just mentioned, payroll tax is one of our higher claim types. So that is obviously a state tax, work cover being state-based as well. So they are covered the same as from the Australian Taxation Office being the federal jurisdiction. So absolutely, we cover those state-based taxes of payroll tax and work cover. In regards to work cover, we're not talking about injury claims. We're talking about where they're looking at the
annual certification.
The annual certification, the declaration of remuneration, and those bodies auditing those figures. And once again, that's from a data matching point of view. They may have paid payroll tax on a certain figure. They've reported to the ATO a certain figure, and the work cover authority are going, hey, you only declared this much. And that may be because of the apprentices. It may be because of contractors. So those sorts of matters are covered under the policy. In relation to Kate there, we'll get back to that question in a moment. I'll just go through this graph that we have. Basically, Roman mentioned that we've been around for 20 years. So we have 20 years of data. Clearly, we don't see every audit that's out there. We see those for those accountants that have got Audit Shield, and more importantly, from their clients that decide to participate. But we have a lot of data from over 20 years. And if we look at the trends here, you'll see that 20 years last year and this year, that the ATO, to their credit, are actually taking less time to deal with audits. The actual participation time is coming down. Now, our ATO high wealth, clearly, we don't have 20 years of data for that because that's been around for 7 years possibly.
That's under the next 5,000.
Yes, under the next 5,000. So, but you can see that they are, in general, the longest running audit types that we see, and hence, you know, the cost in relation to those can add up just due to the length of time in relation to those. But what we have noticed is that in the last financial year, the time that the ATO are taking to respond and to finalise these audit matters are coming down. But even though they're coming down, you'll see the line running through there at 90 days. Under our policy, if a claim has been opened for more than 90 days, and when I say a claim's been opened, we're talking about from the date you were first notified from the tax office or any government agency that we cover. If that claim has been open for more than 90 days, we don't expect you to have to carry your whip for all of that amount of time. And you're able to put in an interim claim for your work up until then, and then every 90 days after that. So once again, we don't expect you to have to carry a whip. We look at a high wealth. We're talking, you know, it did get up to over 400 days. It's now down to 260 days. So there could have been 4 interim payments along the way that we would be able to pay you rather than you having to carry your whip for 250 days. So that 90-day line that we'll see across, you'll see that most of these audit types are still either close to or over the 90-day period. So that is something that you can make use of in terms of invoicing us every 90 days for us to make an interim payment.
An observation I've got in this chart here, Michael, is that you know, some of the big falls in there. So if you look at the income tax full general combined, now for us, that's a category that we basically say they're not just looking at one thing in particular. They could be looking at multiple things, even multiple returns. So like the income tax return plus your BAS statements, for argument's sake, could be in there. So it's either full audit, generally looking at something, or they're combining BASs and income tax return. So you know, if you look at the average out there, which is in that aqua colour there over all that period of time, so that's, you know, just over 200 days there, and now we're looking at the, you know, last 2 years, that number has come down a lot in that aspect. So you know, that's always got to be a good sign that when matters come in and get finalised pretty quickly. So we don't know whether that's a factor of how well the accounts are now responding back out with having better access to historical data, or whether it's the ATO's aspect yet, so we haven't got a sense of that. But any time that these matters sort of get done more quickly, more efficiently, is always a good sign.
Yeah, I think that one of the things you mentioned there is quite topical, and that is the access to data. You know, you don't need to go and find your bank statements in the shoebox. You know, you can access that information online. So a lot of the information that the ATO are asking for, the accountants can now access in a much timely manner, which obviously they can respond quicker, and that's leading to the number of days that the audit's taking being reduced.
And I think I would add in, once again, my view is that the ATO are asking a lot of questions that they already know the answer to, because they have so much data now themselves that I see, say, a number of tax gap audits and other audits where people are asked to complete a personal living expense questionnaire. Basically, it's like applying for a home loan with everything you've got to put in there. I think they already know what assets you own, lifestyle assets, etc. Because you know, even in the last 2 weeks, I've seen they've got access now to all these insurance company information based on different categories of assets and values. Your property management agents, landlord insurance. You know, they're tapping into Airbnb, all the different agencies now giving data that they've already put together, call it a mud map of what they're expecting the answers to be. And if your answers don't look anything like that, what might be a review soon gets escalated to be an audit. Hence, takes longer, obviously.
But I think one of the classic examples that I've seen was where it was an FBT audit. The client produced their logbooks, gave them all the information, and then the ATO come back and denied the claim because they said, based on foreign affair records, you're out of the country on this date, and this date. So there's no way knowing you could be driving your car. So that just goes to show the amount of data that the ATO does have.
And cross-matching.
Have access to and are matching with everything. You know, the fact that they could basically say you weren't even in the country on these days. You know, they clearly have access to a lot of data.
And the other thing I've noticed is, I know we're chopping and changing a bit, but on work-related expenses, that, you know, back in my day in the practice, I never saw this happen, that the ATO now go to the employer, wanting them to validate, well, why did Michael have to spend all this money on what he says are work-related expenses? Why weren't you reimbursing him for these? Or did he have to use his car for work? And the employer comes back and goes, car for work? He comes to the office 5 days a week. He doesn't even own it. That never used to happen. It does now. And it goes in theory, well, why isn't the employer paying for their work-related expenses, so to speak? So they're just a lot more detailed in what they're doing than perhaps they used to be.
And I'll put one in for the software now as well. So with the accounting softwares that exist out there at the moment, the ability for them to capture the data, and not only now the transactions, but also now your ability to attach receipts to various transactions inside there. So again, the ability to be able to retrieve and support any questions that come from the revenue agencies, I think is getting better and better in there as well. So technology and accounting software, I think, and clients' processes, and maybe that's, you know, give credit to the accountants for guiding them down that path and getting them used to you know, recording things. You know, God bless the cloud for a lot of this stuff as well. So so I think that also helps in there as well. So it's a combination of lots of things, I think, that are happening.
Before we move on to the next section, Roman, there's a question from Kate. There used to be industry averages that could apply to businesses for expected level of deductions against other criteria. Are they still updated and published? Are there any similar averages published for individuals in particular industries? So Roman mentioned that the three of us all had substantial amount of years in public practice. I'm the most recent one being 7 years ago. And to be honest, I wouldn't know the answer to that question as to whether those averages, yes, absolutely. I remember they used to be there. I don't think they are there. If someone can add anything, please type an answer in the chat. But my understanding is those sorts of things are no longer there.
Well, certainly the industry guides, job description type guides out there. But the bottom line out of all of this is that you still have required to have spent the money. So just because you're a nurse doesn't mean you get to claim all these or this amount for anything. It becomes you're a nurse, and if you'd spent money on this, then you can claim it. So that's the so I think that's what those guides are all about, not about saying, okay, as a nurse I can claim you know, these 20 items whether I spent them or not. So there's no automatic deductions yet. I know going back in. You know, we'll never get to this space, I don't think, in a hurry. But when we talked about not having to file I-returns in Australia, one of the things that they came up with was to say, well, okay, the problem with not filing I-returns is people are going to miss out on their work-related expense claims. So one of the solutions was everybody has an automatic $1,000 work-related expense deduction, and if you wanted to claim more than that $1,000, then you've got to fill in the tax return to be able to claim that more than $1,000. But otherwise, it would be like New Zealand, where you don't. There's an assumed $1,000. They've got all the revenue coming into them. Assume $1,000 work-related expenses, and that was it. I think in Australia we can't get our heads around this concept of sort of getting rid of doing I-returns for straightforward employees, unfortunately. So it'd be good if it did, but we're not quite there yet.
Well, I think the ATO also are still using what we call their warning, alert, information, scaremongering campaigns, where without, and I agree, I haven't seen those updated averages published in a few years, and I'm pretty much tap into most ATO bulletins and things that come out. No accounts have been talking to me about it, etc. So I'm actually on a no, I haven't. I'm not sure they do it anymore. But they're certainly still using these campaigns of sending people letters, oh, look, your work-related expenses are high, you might want to consider reviewing your return to see that it was correct, even though you said it was correct. And if you want to make a voluntary disclosure and amend your return, then we won't penalise you. Don't contact us. We may contact you in the future. So just to be clear, we don't cover that type of letter because it's not compulsory. You can throw the letter in the bin if you want. But any action you take on those is voluntary. There's no requirement to do anything. And I say, isn't that what you did when you did the return? But I understand that's not always how it goes down. Yeah.
Moving on to another new perspective, another new look at what we're trying to show you here is, so a lot of our data that we've presented so far represents all firms now, but our mix of firms, as I described earlier on, represent sort of put them in the three buckets here. So smaller type firms, medium type firms, and larger firms. So these next lot of screens is for us to try and have a look at. Say, well, sort of this is what we saw all audits to be. What differs when we break them down into those three categories of audits? So hopefully it's not overly confusing here in this little slide. But basically, the left-hand side is the pie chart in table format that already Rod's been through, and on the right side is that segment based on just smaller firms, and what does that look like? So you'll see that the top four pretty much are still the top four. They just change a little bit in the order, and then you've got some bigger changes, if you like. So BASs shoot up the list a little bit inside there, and there's no surprise that ATO high wealth audits reduced down in their frequency in the smaller firms, just because of the typical client base that would exist in smaller firms as a broad general statement in there. A lot of the others are pretty much almost in a similar. Obviously, rental properties gets a little bit higher. So for your mum and dad investors who own rental properties will most likely be with smaller firms as a general broad categorisation. So that's the sort of the mix that exists there. So if we then look at and just say, okay, well, what are the medium-sized firms? What happens there, and what's the change? So the top two are the top two still, so they remain unchanged, and employer obligations jump up to third because work-related expenses dropped away to ninth in that perspective. So, and again, it's possibly a different profile of clientele, possibly in medium type firms as to what they're claiming. Maybe business related more, whatever the profile is. That's the outcome is what's happening through that. And then we just go have a look at the larger firms, and you see the arrows are a mess in what's happening over there, and that's the one that varies the most. Now, I have kept all the data in this one, so go back to Rod's comment, the actual. So all these three slides have the actual data in there, which includes those excess super catch-ups in there. So that's just it was too hard to take it out and still be reflective. So I've just left them in for this purpose. So excess super drops away to a very minor list for larger firms. And so did work-related expenses, which is no surprise there. And then the obvious one again is ATO high wealth for the larger firms jumps up to number 2. So interestingly, payroll tax is still pretty high in that, but that just goes back to all the comments we've made before about why they're there. So larger firms got larger businesses and grouping and contractors, so all those issues associated with those. So other than that, everything sort of kind of moves up a little bit through there. Okay, so Rod, we put this slide up every year, and this is this year's version of it. pretty much. But it just basically highlights the point here that that doesn't matter what accounting firms believe, from their perspective, the quality of work that they do, and sort of from that completion and what they lodge on behalf of the clients. There's still a lot of returns that the end clients do, and you've touched on this earlier on as well. So this is us just looking at that list and sort of what representation of everything we see in the claims value comes from this space. So
that's right. And look, as you know, and your profile of your clients will probably dictate this. I don't think many accountants do payroll anymore. I understand why. I wouldn't touch it with a barge pole if I was still working. Too risky. However, it doesn't matter. So we've got bookkeepers, internal accountants, or the client who thinks they can do everything themselves, doing a lot of the return lodgements themselves, whether it's BAS, supposedly paying the super, payroll tax, work cover that. They reckon they can do all that, and they can. Land tax is not an area that accountants traditionally get very involved with. And if I threw in excess super contributions tax assessments, which we cover, it's probably more like 50%, which is what the stats have shown in the previous years, of types of audits that the accountant might go, you get a super guarantee audit. You go, why are you getting this audit, Roman? And then I have to dig in and work out that Roman's been totally non-compliant with the superannuation guarantee laws. I use the most silly example. What's the rate now of this year? 11.5. Roman didn't increase it from 11 because he didn't press the software update or something. Silly as that. These things do happen. So it's an area that I use when I'm talking to accountants to go, you've got clients, if they're touching, let's call it free government revenue agencies. And once you've got employees, you're involved in super guarantee, you're already with GST, work cover, if you're large enough, payroll tax, you're touching multiple government revenue authorities and lodging returns, which in theory have similar / the same data. Who's checking that? Who's reconciling it? Who's making sure it's all correct? Answer, not the accountant a lot of the times. It's not part of your brief. So I say to clients that go, well, why would I need Audit Shield? Isn't that what I pay you for? That old chestnut. It's not how it works in reality most of the time.
that's right, and it is exactly that. So you're talking about peace of mind from the accountant's perspective, because if clients get audited, how many accountants sort of go through the experience, and somehow the client's looking to say, well, it's your fault somehow that I've got my payroll tax figures wrong. And whether it's even the registration one, it's like we do PI here as well, and we've had sort of PI claims raised on the basis that the client has held the accountant to responsible for the fact that they didn't register for payroll tax when they've not even in control of what their payroll is growing at throughout the whole year. So at the moment we're saying here it's 44% of all the claims that we see fit into this category, that they could be coming from work that the accountant hasn't necessarily seen. Now we know that's not exactly entirely full, because a lot of accountants do BAS returns for their clients. I get that, but anyway, that's the concept. And last year it was almost 50%, so it's come down a little bit from the previous year.
That's because we took ECT out.
Okay, there you go.
Rod, while you're mentioning ECT, there's a question there from Crystal. What is ATO audit on individual excess super contributions? Please give some examples.
So we made a conscious decision a number of years ago when excess contributions tax became a new tax, if you like. So any client, which will always be an individual, who receives a letter or an assessment or an amended assessment from the ATO for excess concessional or non-concessional contributions, any work that you do around that, which can be little to none to a lot if it's wrong, is a type of claim that we have covered, and is one that not many accountants understood that we did cover. So we've been telling more and more that it is covered. Now, I didn't say Div 293. I said excess contributions tax assessments. So every time I do one of these webinars, people ask, what about Div 293? No, that's not one that we're covering. So we've covered ECT and we'll continue to cover that.
And there's one other question there. Are you seeing an increase in Div 7A in Section 109N audits?
I wouldn't say yes as a specific category, but in terms of the combined full ATO type audits, I can guarantee you that the key is, as soon as you have to submit the financial statements, which is like the number one on every audit list that I see from the ATO, once they got the financials, they're trolling through them, whether it's expenses or the balance sheet, looking for debit loans. It's in there. It's buried away in those type of audits. But I don't see specific Div 7A audits on their own so much. It's all about the combined audit where they're looking at a lot more things, and that's just one of them. That's on the checklist
when they're doing the audits.
And yeah, so if you haven't got your loan agreements and the correct interest and everything else in place, look out.
Yeah. Okay. Okay, let's move along here. So both of you guys go out and do those presentations that you've talked about in the past. So so this slide, I'll hand over to both of you guys to sort of further reiterate. You've mentioned a couple already, Rod, what people are missing out on in sort of audits that I don't think are covered. So run us through some of these.
Yeah, it really comes back to our very wide definition of what an audit is defined as under our policy, and it is reviews, inquiries, examinations, investigations, or audits of lodged returns linked to the tax collecting functions of federal or state revenue authorities, or financial compliance obligations, which essentially means employer obligations, super guarantee being the main. So I still find lots of accountants haven't quite gathered that a review, which is not, they'll go, oh, but that wasn't an audit, that was a review. I go, yeah, and it's still a claim. A lot of audits now are the escalation of what was a review into an audit. So we cover it from the phone call, the email, whatever starts it off. If the ATO or whoever are asking questions, there's a compulsion to respond. You have to provide information to validate, substantiate the position, etc. Then we're covering it, including like a phone call that's just asking a few questions about a lodged return. So I think there's a lot more claims in there than what accountants may have realised, and that's why I say that they're potentially missing out on them. Again, data matching things. So I'm seeing a lot more auto-generated changes to returns being made, where you might lodge a return and the outcome on the assessment is different because the ATO stopped the return, review it internally, remember that word, and then make changes to certain items in the return based on the data and information that they have. Could be interest, income, dividend income, health insurance rebates, Medicare levy surcharge, a super contribution deduction gets denied. Doesn't matter what the reason is. If the ATO have stopped the return, reviewed it and changed it, then the time that you spend dealing with that is on face value covered by Audit Shield.
And just on that one, basically the notice of assessment would be considered the notification that a review has commenced. So that would be the start date, the date of notification, date of assessment.
If there's been changes.
Yeah.
So EC2 we already talked about. High wealth or pre-engagement, pre-lodgement reviews, mainly around CGT transactions, is something. And Fair Work Ombudsman. Look, we don't cover complaint, dispute resolution, employment law matters. It's got to be a broad-based audit of the whole employee cohort of the business, where Fair Work are looking at the payments made to all employees, whether they're compliant with the industry awards that affect that business, depending on what they do. And they're pretty active in doing audits on certain industries and regions and other things, for example. So there's a few things there that you might take away, but I think the biggest one to me is that definition of audit review. Doesn't have to be an audit of an income tax return. It can be a review, it can be an inquiry, it can be whatever. And I think that's something you just need to be aware of.
We spend a bit of time going out to accountants' practices to have sort of similar conversations about this, to help educate the firms internally so they don't miss out on some of the stuff. So if at any point there in time, if you're a client of ours and you would like one of these presentations to your broader staff, please reach out to your account manager and we'll look to facilitate that session. They fit perfectly in whenever you do your internal training days, to sort of allocate half an hour or so to time to get us in there and form part of that. So okay, so now we're up to here. So right, this is what a lot of people are here to listen to. So some of your predictions. So for 24, 25.
Look, I'm not going to say these are all my predictions. I might claim if they come through in fruition, but maybe I'm just pinching a few what the ATO been banging on about that they're going to be looking at, which is not that dissimilar to what they said they were going to look at for the current year, but and the year before. But again, work-related expenses is, to me, just going to keep getting more and more attention. We've got sort of work from home claims now, the old cut and paste, if you like, one year after the other. You know, I don't see it being a big area, but it might be something that gets more focused. Rental properties, look, the ATO are all over rental properties, like holiday homes that are not genuinely available for rent, newly purchased properties, repairs and maintenance versus capital, you know, who's through Airbnb stays, etc. You can't get away with not declaring that anymore. I've heard from a number of different sources, people sitting on steering groups and panels and whatever with the ATO, that they got a bit of a bee in their bonnet. They think there's some not correct treatment going on drawdowns on loans, where drawdowns are being made for personal use, and people are still claiming the full expense against their rental property. I'm not sure that would happen all that often, but I keep hearing that's something they're looking at. So, you know, rental properties has always been a large area, and it'll just continue to be. The sharing economy, you know, the ATO is getting data now from Uber, Airtasker, all these different sharing economies. So if you're not declaring the income or whatever, then you're really just a sitting duck, unlike how it may have used to be. And look, cryptocurrency. Look, I've been waiting for the last 3 years to see the big audits, you know, the floodgates open on crypto assets. You know, since then, it's turned up in the pre-fill where the ATO's got data that a person has cryptocurrency. It doesn't have numbers next to it. And when I talk to accountants, I go, well, what do they know? And they go, we don't know what they know. And half the time we didn't know that client even had crypto because they never told us. They just thought it was a game. They didn't have to declare it if they sold it. And then I say, well, what are these tax reports that you get? Are they any good? And I get told they're a load of rubbish. So I think it's evolving. I'm not sure the ATO's got enough evidence to be able to audit because they already know the answers. But I expect it to become a higher audit category going forward. I can't see how it can't be.
Question from Joanne. Joanne's asking, we spend a lot of time talking to the ATO with TFN compromised clients, particularly if there's fraud involved. Is this an area we can claim? So face value, the initial answer is no. The tax file number issues and just managing tax file numbers is an administrative process that you're dealing with the tax office. Remembering that the core thing that Rod was talking about is there's a tax return there somewhere. And the audits that we cover about validated, justified, and substantiated, and supporting items in that return that have been challenged by the tax office. Sort of tax file number issues, unfortunately, are it's a sad sign, but they're not covered by by our product because it's administered in nature.
However, there have been some examples this year where it's more than the TFN's compromised. A return has been lodged by a scammer or whatever, and a refund has been paid, and the accountant becomes involved in the fraudulent return, dealing with the tax office, which effectively auditing that scammed return that they didn't lodge, but they're now involved. So we have had some, it's a case by case. We have had some examples where that's been granted as a claim because they were actually validating, substantiating what was in the return. But I always say, surely there becomes a point in time where the accountant's out the door and the cops are involved and the fraud squads are involved. They're going to catch the perpetrator and your role's over. So case by case, I'll listen to it. But if it's just somebody stole my TFN, then no, that's not.
Yeah, no, fair enough. Okay, so now I'll get back to my slides here. Okay, so basically we're sort of now at the end of the webinar coming up here. So basically this is just a little bit about us. Again, what we do, so we do our three products: tax, audit, insurance, cyber, and professional indemnity insurance, as you know. So we're using this sort of latest in technology. We're ISO accredited for the extra security for what the data we hold and how we hold it and the processes we do. So that's sort of a little bit about us. It's now. So we're going through. So just seeing if there's any more questions that anybody wants to ask through here. We'll wait to give a few more, a minute or so for people to pop up any questions that they may have in regards to this.
So Michael Curtin's got one. What is the time frame from receiving a personal assessment for a client resulting in additional tax to notifying Audit Shield? So as Rod said, if the notice of assessment differs to what you filed in the tax return, we consider that the ATO has already commenced a silent review, right? So basically your client would have had to have paid for Audit Shield prior to that notice of assessment being issued, because the day you get that notice of assessment is considered the day that you were notified that the ATO had done a silent review. So from that perspective, you get the notice of assessment and it differs to what you filed because the ATO has done their own review, some data matching. You would submit a claim then, and the notice of assessment would be considered the notification letter, and the date on that notice of assessment would be considered the first time that you'd been notified of a claim, and you would upload that.
And that would also mean if a client appeared on the delayed tax return report that every accountant gets every week, they need to, and they're looking at, certainly looking at income and expenses, then they need to be paid before that as well, even though you've got nothing to do at that point in time. That's another trigger that we look at.
Roman, you may be able to answer Margaret's question.
Margaret, I'm not sure where that's coming from. Seriously, does the client have to be with you for at least 6 months? No, that's not correct at all. So basically, our model is that we work through the accounting firms to offer something to so a new client. Okay. So no, so it is 6 weeks. It's not 6 months, and that's for a new client. That's 6 weeks, so not 6 months at all. So and the rationale behind some of that, unfortunately, is the concept of that the insurance industry has gone through with the Royal Commission. That they're looking at sort of this add-on insurance concept. So they consider tax audit insurance offered by accountants to be add-on insurance at this stage now. So to avoid any of the issues associated with trying to deal with the deferred sales model concept that the insurance industry created to manage this, or the government regulated to manage this, we've put a little bit of a time frame in there to deal with new clients. Now we're working with the insurer now to see whether there's There's some better interpretation with regard to existing clients who have moved accountants who have had the product in the past. So we're just waiting for confirmation on those things. So it is a technical thing that exists. And exists for any accountant who's offering tax audit insurance. Doesn't matter whatever format they're offering it up in. It's still there. The accountant providing the actual service, and this is offering tax audit insurance, whether directly or through a third party, would be considered to be a potential add-on insurance process. So it should exist for any way you go about offering tax audit insurance. So that's sort of the aspect there. Tresha, hopefully I pronounced that name right. Treshka, sorry.
Yeah, I was just starting to type an answer to that one, Roman. So basically, no, we do not deal with end clients directly. We only offer Audit Shield through accountants. So if someone wants to have Audit Shield, their accountant has to be a client of ours for them to offer it to.
And it's a strategic positioning that we do this for. So your clients are not our clients. And we never we sit behind the accounting firm in what we do and how we do it. So it's the so you are our clients. The accounting firms are our clients, not their clients. So so you always stay in control, which is the point I was making right from the start, the early part. You are in control of your clients and the product that is being offered to them. It's under your control, as opposed to referring it to somebody else and then hoping that they don't increase price, so they don't change the policy wording, their claims experience suits. And so however referring out to an insurance broker works. Our product is not like that. Our product is, we operate everything through the accounting firm, and you are our clients, not your clients.
So Roman, our time is up. Do you want to add some things before we finish?
Okay. So I think we've come around a lot with what we've spoken about here. We're very fortunate that we have lots of accounting firms around Australia, and we operate in New Zealand, Canada. But this is all about just our Australian experiences. We wouldn't be able to capture this data and have this representative conversation if it wasn't for all the accounting firms out there who support us in what we do and how we do it. So we have a big insurance premium pool that allows us to be that stable, predictable, dependable product offering that exists out there. So so thank you for all your attendance, and hopefully we've given you some insights into things that are happening. So thank you very much for your attendance.
Thank you.
Thank you.